So hello from Germany. It's midnight here, nearly midnight, and I'm glad to present my system here. And it's called Schwalbe because, as you read in the announcement, it's the thinking behind this. This is a Schwalbe doesn't make a summer, so you need more than only one Schwalbe for a break. And this is the sign. The event is when there is a break of a trend. But first of all, as always, there is a disclaimer. I think most of you know this from Aromir. Aromir Corporation is not a broker-dealer. I skip this because I think most of you know this this disclaimer. So I go to the real thing. What I want is the requirements. I use options on a mini and I'm using span margin. And my trade duration is always 3 months with the quarterly options, which are March, June, September, and December. And using 25 point strikes is the old version. There's a new version. But I have no overlapping trades and no fat tail risk. And what is really important to me is I want a realistic profit expectation when I open a trade. And I want to have a high probability of winning trades. Hello?
We can hear you just fine. I'm
muscle, and it runs right underneath the IT band.
Okay, please continue.
I don't hear anything.
Hey, can you hear me? Please continue.
Hello? There's a chat. Mute everyone except Igi, the host.
Igi?
Yes?
Go right ahead, Iggy. We're fine.
Okay, you can hear
we
me.
Just
okay.
Somebody was just speaking in the background, and we've muted. Ryan has muted that person now, so we're fine now. Thank you.
Okay, thank you. So, what I really want is no stress when the market has a sharp decline, even when it happens right after opening a trade. This doesn't happen very often, but when it happens, it really can hurt. So another requirement for me is I don't want to adjust every day or every minute or every hour. I want very few adjustments. And that's why I made a backtest from 2015. Not with only the 25 point strikes, but with other strikes. The reason for that is price moves much quicker now than in, for example, in 2008. And here is what's wrong with a broken wing butterfly. A butterfly has a fat tail risk. I will go in detail later on. What I want to tell in advance is back ratios or teenies, they lose power as time passes. And this is a very important thing for me because when I buy a back ratio or I buy a teeny, it's losing power all the time. And that's why a lot of adjustments have been made for renewing a back ratio or a teeny. And that's a thing I really don't like. So another thing is a volatility spike, and I will show some examples for a volatility spike later on. And another thing with a broken wing butterfly, you can get a profit hump, but only if it's near or at the end of the trade and if it's near the upper puts. So why do I use a simple butterfly? I have a profit target right from the beginning. The probability of a price at expiration after 3 months at exactly the same level when opened is extremely low. And I have no fat tail risk. And the so-called sea of death, I will explain the sea of death in 1 minute, can easily reduced by the butterfly below. and I want a good reward to risk ratio, and my system is very robust against volatility spikes. I will go in details with every argument here. This is the old version with 3 butterflies. Now I only use 2 butterflies, so I will skip this. And I want to talk about adjustments. Most of them are fixed, only very little discretionary elements. And one thing is when I have a break level. And this is a fixed break level for every time. And this is a 5% move from lower. This means I exit the trade when the close is minus 5% below the starting point, the starting price, and only end of day. I don't use the open, I don't use the high, and I don't use the low of every day. I only use the end of day data. And adjustments are done by selling upper puts and have to be done as soon as possible. I will declare that in details. And this is another one. I will show this in an example later on. Here are some more adjustments, but I will skip this because I will do this in a explanation of a real trade, which I will declare. I will explain at the end. This is also the old offer. There is a new one I made with Tom today, so I will show you in some minutes. The most important thing is I need a trade idea. And my trade idea, you see it here. This is the S&P, the SPY. As you see it here, it's going from 2004 to 2019. And I do it now in detail. For example, here 2014. Here is the end of day data of the SPY, this one. Can you see that?
Yes, we can.
Okay. And this is a 3-week low. To be more precise, it's the low of the last 15 trading days, not calendar days, trading days. So it's normally 3 weeks, but when there's a holiday, then it's a 3-week and 1 day. So
Could you show us what you're referring to for the 3-week low? Okay, I see a cursor.
This is the red line.
Okay. Oh, that's
this is the red line. Okay. And the green line is the trade duration of a trade. Here is the entry price, and this lasts until the end of the trade. And from this line, from this green line, 5% lower, there's the blue line. And this blue line is my exit line. When the close of the SPY is below this blue line, like here in September the 14th, for example, when here this line is below the blue line, then I exit the trade no matter what happens. Every time when the close is below this price, this blue line, which is 5% below my entry price from the quarterly option, then I exit the trade. So then I use only 2 indicators. One indicator is the break, the cross of the 3-week low. For example, here you see a cross, here you see a cross, and so on. Here you see always a signal when the SPY is crossing the 3-week low. And then I might do an adjustment. But the most important indicator for me is I call it the Schwalbe. The Schwalbe means, simply said, let's do it in a big picture. You see here a Schwalbe. This red here, this red one means here is a trade, and the movement from here of when this movement which happened above the blue line will also be on the next day, then I will be below the blue line.
So in other words, you're halfway toward the blue line?
The signal always will be before the blue line is crossed. And this is my Schwalbe.
So it's when you're halfway toward the 5%.
Yes.
Okay, got it.
So when this movement from here to here will happen the same the next day in the same size, will I be below the blue line, yes or no? And sometimes I will cross the line, but sometimes I will also not cross the line. For example, here you see that. Here was a big move. Here was a big move, and with a big move on the other day with the same size, I would be below the blue line. But this is a false signal. It was a Schwalbe signal, but there was no cross. There was no cross of the blue line, but the signal was here. And I react on these signals here. But the signals doesn't happen very often. Here you see in February, there's one signal. Then the next one is in October in 2014. The next signal is in 2015 in August. Here you see the big movement. And if there will be a big movement like this the next day, then I will be below the blue line, and it happened. So there will be an exit. But the point is, when I prepare here at this level for an exit, I can be better prepared and get out of the trade at a better price than when I will exit here. Because here the loss will be much higher than here, for example. And that's why I want to be prepared for a break. But I don't know if it will happen or not. And here it happens. Here it doesn't happen. Here it happens, but not the next day. It's 1 week later. But here I get prepared for this break. And how I prepare, I will show you in an example. Here's another signal. There was a big move, a really big move here, from here to here. I make it a little bigger. This was in June 2016. Here was a big move to the downside. And if this size will happen the next day, I would be below the blue line. And I got prepared here for a break, but there was no break. Then for 2 years, nothing happened. Then the next signals were 2018 in January. Here was again a big move to the downside. And with this size added here, I would be below the blue line, but there was no break. Same here. And in October 18, there was a break. Here was a big move. Here I get prepared for a move. It's like something like a hurricane. A hurricane may come and may enter the land, but here it entered the land, and here it returned to the sea, for example. So is that clear?
That is clear to me. Let me check Igi around the room here.
Okay.
Are people able to follow the signals? Who is not able to follow? Who has any questions on just the signal itself, which is 50%? If you get to 50% of the way to where you would be 5% down, Igi will correct me if I'm wrong, then you hedge, you partly hedge, your first hedge. Is that clear enough to people?
Yes,
okay,
but it's not 50%. It's not 50%. When there is a big move and on the next day, the size of this move, for example, here it's a move for, let's say, 8 points. When there's an 8-point move on the next day, I would be below the blue line.
It's
So
only looking back one day.
yes. It's only looking back one day. That's not any lagging indicator or something like that. It only depends on the last day.
Got it.
It only depends on the last day. So the formula for this is here. Here I have the quarterly trades here, and then this is the formula, pretty simple. When this happens, then there will be a break, but here is no break because there was a move to the upside again. So
Perfect.
this is the idea what I want to trade. The next question is what strategy do I use to get an edge out of that? And now I want to talk about a butterfly, as I mentioned before. This is a normal butterfly. Here you have the tent. Here's the T plus, here's the 0 line. Here's the T plus 0 line. To be in the trend, there's a probability, and to be out of the below 0, there's also a probability, which is then out of the trend. And here you are negative. Here you might be in profit, and here you are negative. So when you tighten this tent, the probability of being in the tent after 3 months, if you tighten it, the probability is getting lower and lower, because here you have 100 points from here to here. Here you have 50 points. Here you have 25 points, and it's narrow, much more narrow than before with 100, but here the loss is smaller. And if you tighten it more, for example here, the probability of being here after 3 months is very, very, it's not realistic. But what about this? You move this upside down. And what do you have now? Now you have a probability of being in the tent very little, but here is the 0 line. Here you are in profit with a high probability. So you don't buy a broken wing butterfly, a normal butterfly. You sell a butterfly by just putting upside down. Here you are in profit on this side and on this side. And here you are only in profit when you are in this narrow range, which is 15 points to the upside or to the downside. So you might think, okay, but I still want to buy a butterfly, but then you have a problem. Here you see the right side is strictly at the 0 level. And on the left side, you are in a negative. Here you are below 0. So this strategy doesn't work when you buy a broken wing butterfly, because here it's broken, because here you see it here at the downside. Here is 7 to the upside and 8 to the downside. But when you sell the butterfly, You have here a profit below zero, and here you are slightly negative. And the questions to the auditorium is, why does this work and why does it not work when you buy a butterfly? What is the word for this phenomenon? Does that anybody know?
Any volunteers for answering that question?
Skew.
Oh, sorry. Buying versus selling is what Will says.
No, the reason why this works is the so-called skew. But I don't explain the skew, because this can last for 1 hour, for 1 hour to explain exactly the skew. But I want to make a long story short. It only works when you don't buy a broken wing butterfly, but when you sell a broken wing butterfly at the money. Very important, at the money. Because the prices of options are the most expensive when you are at the money. This doesn't work when you sell a broken wing butterfly, for example, here 100 points above or 100 points below. So now I want to talk about the thing I sent to you, Don. I made an analysis of quarterly options from 2004, which are 62 trades. Here I have the so-called C of death, the V. Here I have the A. And the point is, how is the probability of being in the valley or above the valley or below the valley? And here you see the exit below the entry minus 1%, which is here 1%. There are only 15 trades which were below. 6 trades were near the middle, but not in the middle. No trade was exactly at the middle. And 41 trades are above. So when I use this configuration, when the price is above my fee, my XI way, I don't have to adjust anything because here my profit target is below zero. My upper expiration line is above zero. When the price is inside of the V, I have no additional risk until 20 days till expiration, because you can see it here. This magenta line, it's hard to see, but this magenta line here is the line, as you can see it here at the left bottom. This is the T+0 line after 72 days. The whole trade lasts 88 days, and after 72 days, this T+0 line is still pretty close to the price at the beginning. Only the last 2 to 3 weeks before expiration, this line will drop like a rock to the downside. But the good thing of my trade is you have a T+0 line which is pretty close all the time, and the probability that the price will move to the left or to the right is much higher than staying here in the V. So what will happen when I'm below this point? Here I have my so-called spare parts storeroom, and here I have put credit spreads, and here I have put debit spreads. Here I can sell my put credit spreads which will lift up the whole line here to the upside and here to the downside. As I said, I have a 5% break level, and this is here. When the price is below my 5% level, I will cut the trade. No matter if the price is here or here or here or here, I will cut the trade. And here is the analysis from 2004 until 2019. How much is the price away from the entry price after 3 months? Here it's the difference entry exit after 3 months. And you see only one time you are nearly at the middle. But this was this trade, for example, was killed by the 5% level before. Because here it was 2004, I can show you. This was a trade here. Here it started. It ended nearly at the same level, but here was the break. So the possibility of being in the V, in the valley, without any adjustment is very, very low. This is was a very important argument during my analysis. So when I use a broken wing butterfly, which is here, it's here it's the upper expiration line, which is below 0. Here's the lower expiration line, which is much below 0. And there are 3 possibilities. The price is going up, everything is fine, but there's one problem. When it's going to the upside, your theta is going lower and lower and lower. And the upper expiration line is below 0. You have to adjust. And every adjustment costs money. And where do you get the money for the adjustment? You can add your money, or you lift this to the upside, and then the risk here at the bottom is getting higher. So this is the first possibility. The second possibility is the price is inside your tent, and welcome, everything is fine. You can make really a nice profit. But when there will be a drop, for example, of 100 points, what does happen? The volatility is going to the upside, and the volatility will have the effect that this T+0 line will be much more straight at, for example, this level. And here you have the T+0 with no higher volatility, which is not realistic. And the risk, of course, is here when the price is going down, you have a fat tail risk. And here you, of course, you need protection. And every protection costs money.
Just to clarify, Igi, just so I think some people may have missed this, that what you're showing here is not your trade. It's
not my trade, no.
It's a conventional broken wing butterfly, which you are showing is inferior. You're showing ways in which this trade is problematic, but are solved by your trade, which is a different trade.
Here I show what I don't want.
Right.
I don't want a fat tail risk, and I don't want an upper expiration line which is below 0. These are the 2 main things I don't like. I don't want here a fat tail risk and buying a protection which is getting weaker and weaker and weaker as time passes. And here I also have to adjust to push this line to the upside. And this is what I don't want to have.
So these are major weaknesses or deficiencies
Yes.
in broken wing butterfly strategy.
Yes, exactly. So my Schwalbe trade looks like this. As you can see it here, I have here the so-called sea of death. And here I have my spare parts storeroom. And you see here, I don't have any fat tail risk. At the beginning, the price is here. Here, about here is my break level 5%. And I don't have any fat tail risk here. And I have an upper expiration line which is above zero from the beginning. From the beginning. And here, this spare parts storeroom are my so-called, this is my spare parts storeroom. These are put credit spreads, which I can sell when the price is going to the downside. When the price is going to the upside, I don't have any problem. I don't have to adjust anything because here is my upper expiration line and everything is fine. But when the price is going to the upside, this put credit spreads are getting much more expensive. For example, the price for a put credit spread, this is a put credit spread and this is a put debit spread. When, of course, I buy a put credit spread, this line here, the middle and the upper expiration line and even the Y is going to the upside, and here, of course, it's going to the downside. And for example, here a put credit spread is about $4. When the price is going to the downside, you can sell a put credit spread for $5, $6, or even more than $7. And with this money which you get here, you can easily, for example, adjust the value of death by reducing it. You can move here the left and the right side to the center, or you can, for example, buy back the butterflies by reducing 7 to 3 or 4 example. And these are the adjustments which are possible. And the most important thing is I don't add money. I don't add money to my system because I have no fat tail risk. And when I use money for adjustments, I can sell put credit spreads and I don't have to adjust anything when the price is going to the upside, because here I have a profit line which is above zero from the beginning. I only have two problems. The biggest problem here is the sea of death. And the next problem is when I cross the 5% level. So why do I use an asymmetric V? When the price tends mostly to the upside, no adjustment is necessary because here I have a profit line above zero. If the price is below my entry of A, if the price is below entry, the put credit spreads of A, here my spare parts storeroom, adjust the middle expiration line to the upside, and also the sea of death and the upper expiration line. And here is my break level. And the break level is calculated by the SPY data, not for the S data, because there is cost of carry in the A-mini futures. And the lower expiration line, of course, is going to the downside, when here it's going to the upside. So here is a broken wing butterfly, which I don't prefer. This butterfly has back ratio for the fat tail risk. But very important here you see the different T+0 lines, which is here the blue one is this one, the upper is T+0. The next one is plus 18 days, 36, 54, or 72. So when the volatility here, you see when the volatility is going up 20 points, then your protection is fine when it happens right after you exit a trade, entered a trade. But what about your protection when this move to the downside happened after, for example, 36 days? Then this is your protection, and you are pretty in a loss. There's only
Okay.
one.
Okay, great. Wait, Iggy, just to clarify, so in case anybody misses this, you're showing again back here to the alternative strategy, not yours. But
Yes.
here you're showing a broken wing butterfly on the right, and on the left you have hedged it.
Yes,
So
by a back ratio.
some sort of hedge has to be made. So we're using a back ratio hedge,
Yes.
but you're showing that that back ratio hedge is very deficient in its hedging ability.
Yes, because as time passes, here your protection is getting lower and lower and lower and lower. And the protection is fine when the movement to the downside happens right after opening a trade. But you have problems when there will be the move after 2 or 3 or 4 or 5 or 6 months, because your protection is not on this level, it's here down. And this is what I don't like. And here you see both trades, my trade and the broken wing butterfly with a protection. And the protection always lowers, this is very important, a protection here always lowers the upper expiration line of a broken wing butterfly to the downside. And here, this is the same number of options used. Here are 4 and 4, and here are also, you see it here, I have 8 to the upside and 7 to the downside, and here 3 to the upside and 3 to the downside. And here you see there is also a T+0 line in the green system, but it's pretty close to 0 here because you really nearly can't see it. Here you see, here is the green line. And here's the blue line from the broken wing butterfly with a protection here by back ratios. And now look what happens. These are the different T+0 lines after 18 days or 36 days or 54 or 72 days. This is your protection with a back ratio. And here again, you see all the lines of my system here are pretty flat. But the most important thing here, look at the right side. Here is the price. You see my different expiration lines here are pretty close all the time. Here are the different expiration lines of the broken wing butterfly. And of course, if the price doesn't move here, you can make a nice profit. But here the lines are pretty close. And if the price is moving to the upside, which is doing most of the time, then here you don't know. The problem is you don't know when to adjust your broken wing butterfly. Do I close it now? What is your theta? What is your delta doing? Do I have a positive or a negative delta? What is my theta doing? And you know the theta, if the price is going to the upside, the theta is going lower and lower and lower. Next point here. Here I have a move of the volatility of 10 points. Why do I use 10 points? there are really very big moves, but these are are not very often. And if you compare here, this is, you see it here, the volume adjust is here at 0. And when there's a move to the downside, the volatility is going to the upside. And now let's look, where is your protection? Do you really have a protection when the volatility is going to the upside, which means the price is going to the downside? Here you see with my trade, it's pretty close. I don't have any fat tail risk. Here you have a fat tail risk. And the most important thing, we are talking about a profit of 500 to maybe 1K or even 2Ks. But your maximum risk is at 20,000 or 26K. So you have here the very big risk for a pretty small profit. The relation between here and here could be better. And in my case, I have no big risk here and nearly the same profit line to the right side. And when the price is going to the downside, look what the price is doing when you, for example, when you have a movement of 10% in the volatility to the upside, you may have a move of 100 points to the downside. When you have 100 points to the downside, look where your T+0 lines are. With the broken wing butterfly. And my T+0 lines are still all pretty close. This is when the volatility explodes by 20 points. Then it's okay when it happens right after opening a trade. But when it happens later on, look what your protection is doing. It's getting weaker and weaker and weaker and weaker. But I can congratulate when there's a movement of 40 points to the upside, which is not very often. Which is really not very often. And to speculate on a movement like this, that's not trading, that's casino. So now this is an example when I use the same maximum risk. Here you see the bottom is here at minus 27K, same here. But my fat tail risk is here still at 2K. And my profit line is also at 2K. So my risk is here, the value of death. And when the price is going to the downside, I can use adjustments here to lift this here up and also to reduce the C of death here. And what is very important, look when there will be a problem with the C of death. Here you see this magenta line here is the T+0 after 72 days. So there are still 16 days until expiration. And look, I'll make it bigger. Here is the T+0 line of the broken wing butterfly. And here's the T+0 line of my Schwalbe trade. And here you see, even where there are 72 days later, I really don't have a risk with the C of death here because I'm still inside of 2K maximum loss. So this risk will only happen the last 14, 16 days. And I have enough time to reduce this risk when the price is still in this area and I didn't have any possibility to sell any put credit spreads here to lift this up this in this situation. So this is the same with volatility going up 10%. And here you see it more in detail. Here is my 5% break level. When the price is below here, I cut the trade. These lines here are from the broken wing butterfly, and these lines are pretty close. These lines are pretty close, and my maximum risk is at 2,000. And here, from here at the beginning, you are with the broken wing butterfly in this combination, you are below the 2,000. So to make a long story short is I want to show you how resilient my trade is against volatility spikes. And here you see, here I have, when I use the same risk for both systems, my T+0 line on the right side is at nearly 2K. This is still at about 500. And here, after 72 days, the magenta line is going lower and lower and lower. And one more thing is important for me. You don't know how the price will move. Will it move to the upside? Will it move to the downside? And your broken wing butterfly, do I adjust my broken wing butterfly? Yes or no? And when do I adjust? And how do I adjust, and so on? All the things which make the thing complicate here when the price moves to the upside, which it is doing most of the time. I don't have to do anything because I want this trade to expire, and I am at Interactive Brokers. When my trade expires, I don't pay any commissions for a trade which expires. And I don't have to think about, do I close the trade, yes or no, or later, or what is my theta doing, and so on. Because here you see the theta is going to the upside, and with the broken wing butterfly, your theta is going to the downside. Here you see it in without the different T+0 lines. My risk here is pretty flat. And here I'm at the upside, above the zero, much more than with the broken wing butterfly. But of course, you can adjust your butterfly to the upside, but then your risk is going bigger. But there are different reverse Harvey and so on. Of course, you can make profits with a broken wing butterfly, but it's a matter of risk, and I'm talking about risk. What do I risk to get a profit? And here I am at 1-to-1 relationship. And here I don't have the relationship 1-to-1. And this is all I talk about. Here I show you now a live trade. This is black. Should I switch it to white? Is that better?
That looks very clear, but if you want to flip it both ways, we could, but that looks clear to me.
The black one is okay?
People agree? Yeah, people say they like it like that.
Okay. Here I opened the trade on September, I think it was the 23rd of September. This is the old version with a 50 point, with a 30 point to the upside and 30 point to the downside. The new system is only 15 points because I always have with the first trade here, when the price is going to the downside and more than 1%, I have to adjust first this value of death. And I made a test. What about making this much more narrow to reduce it from 30 points to 15 points? And also, I don't need so much puts here to buy, so I can reduce them. But this was a trade which is a live trade, I entered on the 23rd of September. Then one day later, the price was here at the beginning. Then it moved to the downside. And what happened? You see it here. Here it's going to the downside, and here it's going to the upside. All from here, on this line here, the turquoise line is going to the upside. And I sold.
Could you show that again, Iggy, please? The animation.
Here you see the same level here. Here you see the same level. And now I sell a put credit spread. Here it's going to the downside, and here, from here on, it's going to the upside. The numbers are not so easy to see. Here you are at minus 625. And here you are at minus 625. When I sell a put credit spread, then here I'm at minus 1,625. And here I'm up to minus 375. You see that difference?
Oh, absolutely. Yeah. Thanks.
So, and with this first adjustment, here I got money. I didn't add money. I got money for the put credit spread, because at the beginning the price for this put credit spread was about $4, and I sold it for $5.
So when you say you sold a put credit spread, you mean you sold one that you already had, not that you entered a new short.
Yes, because here I bought 10 butterflies in this version, which is a put credit spread and a put debit spread. And one put credit spread I sold here for $5, and with this $5 I made this. Can you see that? I reduced my C of death by more than 50%. The risk was here at minus 9K. And now it's at about 4.5K. Because with this put credit spread, I financed moving this minus 9 to minus 4.5, moving by 50% to the upside, reducing my risk dramatically by more than 50%.
That's great. And when would you do this?
I did that one day later, because the price at the beginning was here, and then the price went down more than 1%, 30 points lower. The price was here, and then I sold my first put credit spread. So then the price went further. I sold another put credit spread. You see it here. My risk is here going up to 2,740. And here, from here, all this line is going to the upside. And the price went deeper, and I sold another one. Now with this line, I'm above zero. And my maximum risk is about 3,700. This is my fat tail risk, which is at the same level like my C of death. So here you see I got 7.50 for the first put credit spread, I got $5, and this money I invested for reducing the risk. This money for the put credit spread here, 7.50 and 6.50, I still have. And this I will use for reducing the sea of death. This is one possibility, or buying back a put credit spread by less than 50%. And this is what I made. Here, I bought back a put credit spread. I reduced my fat tail risk from 3,700 to 2,500. And I got, for the first one, I got $5, and I bought it back for 2.75, and the price was at in this area about. Then the next thing I did was today the price is going to the upside, and when the price is going to the upside, reducing this V is getting cheaper, because there is one very important thing. To do the adjustments as soon as possible by buying put credit spreads should be as soon as possible, because as time passes, this put credit spread is getting cheaper and cheaper and cheaper. When the price is going to the downside, they get more expensive, but it's okay when it happens the first month or the first 2 months, but in the last month before expiration, you don't get any good price for the put credit spreads here. It's the opposite thing when I buy here normal butterflies, because as you know, when you have a butterfly like this, to reduce this valley, then the price for the butterfly is going to the upside. I can demonstrate this. Let me see. I can do it. Butterfly. Here, when I buy a butterfly and the time passes, then of course the T+0 line is going to the upside. And it's getting more expensive the later you buy a butterfly to reduce the value of death. So that's why there is one priority to do. First of all, the sooner you can reduce the sea of death, the better. And the sooner you can sell put credit spreads, then it's better. And to do this from the beginning again, that was the beginning here. And there was a luck that one or 2 days later, the price was not here at the beginning, but the price was here. Then I sold a put credit spread and lifted here up. And for the money I got here, which was $5, I financed reducing the sea of death by more than 50%. So the next thing is the price is going down again. I sold another credit spread, then I sold another credit spread. So now at the beginning I was at, what was it, minus 600, I think. Now I'm above zero. And here my T+0 is not at 500 at the beginning, it's now at 1,300. Then what I did today is, not today, it was on the 25th. It was 3 days before, so it was on Friday. I bought back a put credit spread. I reduced here the fat tail risk from 3,700 to 2,500. And of course here it will getting a little lower, but I bought it back for less than 50%. And the next thing which I have done today, I additionally bought a butterfly to reduce here the sea of death. And the next thing I will do, I will buy more butterflies to put it here to make that flat. And now one very fine thing. Here I am below zero. Here I am above zero. Here I have a nice profit of about 1K, and here I am below at about 277, sorry. So when the price is hovering around here in this area, I could make a profit here or a loss here, but there's still a possibility. I sell this last vertical and buy it back, and now I have a profit line which is not as high as before, but here I have a profit line of 500 from the beginning at minus 5% to whatever it will be to the upside. And this is all because I sold put credit spreads here and can finance all the adjustments for using here to lift this line to the upside. And when I am in the region of a higher price than at the beginning, which is the most realistic scenario, then I have a nice profit. But when it's going to the downside, I can adjust. And here I have a flat line. And I don't add any money. I get my money by selling put credit spreads only when the price is going to the downside. When the price is going to the upside, I don't have to adjust to make any adjustments because I have a profit line which is above zero. And I don't have a fat tail risk. My maximum risk was at 3,500 600. And the valley of death is only really only hurts only the last 2 weeks before expiration, and I have 12 weeks, so I have 10 weeks for I have 10 weeks time to adjust the valley, and I only have to adjust when the price is here in this area. But when it's going to the upside, I don't have adjust, because when the price is here, do I have to do an adjustment? No. And so this is the live trade from today. This is the situation from the trade, which is now live at Interactive Brokers. Here you see my maximum risk is at 2,600, and here my maximum risk is at 2,500, and my profit line is here at 1,100. And the risk is here, and the profit is here, and the relationship, that's pretty fine. And I don't have to renew my insurance against spikes to the downside. Because when the volatility is going to the upside, let's show this. Let's do a volatility spike of 20%. Look what my T+0 line is doing. It doesn't move much. Do I have a bigger risk? I don't know. I don't think so. I can adjust 40 points. Look where my T plus 0 is. Do I have any problems? My maximum risk is 2,500, and the higher the volatility, the less my risk is. That's my trade. Now I made back tests with my new version, and I will show this. This was a version without any adjustment using my Schwalbe and the 3-week break. And here you see I have some problems when there's a spike to the downside. There are some drawdowns here and here and here and here. And when I use the adjustments, when something like this here happens, to make the things flat, then it's like this. And when I cut a trade, when it crossed the 5%, I don't add any new trade. I wait for the new quarter to enter a trade, because I don't know will the price, for example, return to the upside, or like here, drop to the downside, or here much more difficult, going down, going up, going down, going up, and going down again. And this is, I cut 5% and no matter what happens. Here I cut 5% and finished, and I wait for the December for opening a new trade. And here to make a summary is, these are all the trades from December 14 to June 19. This is the back test. And here you see sometimes in OptionNet Explorer, I have to cut the trade, to close the trade at the end and have to pay commissions. But when a trade expires worthless, then I don't have to pay commissions. And there are some days when I don't have to pay any commissions when the trade expires. So I don't have to pay $74, but only let's say half of it, which is about $40 commissions. And the thing is, here you see one more important thing is when you get performance data, then you most see the trade from the beginning and the result, but you don't know what happened in between. You know there was a drawdown, or the trade was ended in a positive area, but you don't know if there was a drawdown. And with this here, with this summary here, you see exactly how much was the biggest drawdown I ever had in this system when I trade only end of day data. And for example, this is, sorry, Mr. Locke, this was I got it from the internet. Here you see there are performance data, but when you see something like this, here you have, look at this, does consider overlapping trades. So when you think you have an amount of money and there are 12 trades, so 12 trades means one trade a month. And this might be overlapping trades. So the capital you have maybe you have to divide your capital, because don't get for an investment the 34%, because there are overlapping trades. And here you have a negative performance, and 37% to the downside is about 58% to the upside. And I don't want to have a minus year. And here you see, this is the S&P, plus 21%, minus 5%, plus 21%, plus 12%, plus 1%. And here's the performance of my trade: 28, 37, 41, 19, 21. Because the most important thing for me is reducing the loss. I have, as I showed here, I have a version which is reducing the loss as much as possible, but with no hindsight, with fixed adjustments, by using only two indicators, which is the Schwalbe and the 3-week low. And this one is without any adjustments, but with much bigger spikes to the downside. So you have here, you have nearly the same result. Here you are at about 9K, and here you are at about below 9K, a little bit lower, but your drawdown is much less. So the thing is to reduce the risk all the time as much as possible. And that's why I use a strategy. That's why I use a strategy when, where is it? That's why I use a strategy when I don't have any fat tail risk. Here I have my spare part storeroom and can reduce the risk here, which is the biggest risk. Here I cut the trade at minus 5%. Here I have a profit line from the beginning when the price is moving to the upside, which happens most of the time. That's my trade. And here at the end, I have a special offer. It's here only for this meeting. I can offer you the Schwalbe trades from now on until the end of Friday, the 20th of March, 2020, for 147, which is five months about. And if a group of 5 persons will join, you get a rebate of about 10%. And when there are more of 10 persons, then you get a rebate of 20% for this membership. So thank you for watching. And now I think there are a lot of questions.
Thank you. Well, it's extremely impressive. Who would like to ask some questions? Michael.
Going back to the very beginning, you were trading an option on an E-mini, and I'm not terribly familiar with those. So if you trade on the close, that's the signal. Are you trading into the past the 4 o'clock period, or how does that work?
Yeah, during the day, every time in the morning, I will send an SMS and an email if I intend to do anything. And sometimes I say I want to, for example, buy back a put credit spread for about $2, and then I put in a limit. And this can happen during the day, but the most of the time I only will do an adjustment at the end of day, or after, for example, afternoon. So
Well, if your closing signal is the close of the day, when does the trade occur?
The signal is always from the day before.
Okay.
So the Schwalbe will show a signal which is the day before there might be a break. And when there is a Schwalbe, I see that there might be an adjustment. Then I do it at the last, for example, 30 minutes before the market closes, because I see there might be coming something. There might be the event, and then I will send a message that there might be an adjustment the last hour, for example, and the exact adjustment I will tell 1 hour or 30 minutes before the market closes. But this
Okay.
really don't happen very often.
Okay.
So
One other question.
Yeah.
Are the number of lots equivalent in the upper tent and the lower tent?
Pardon, one more time?
You mean, see, well, in your terminology, that would be the A and the V. He's saying how many contracts, are the number of contracts between the A and the V roughly equal?
Here at the beginning, this is sorry, this is the old version, but I can show it in the new version. This is OptionNet Explorer. I use OptionNet Explorer, and with a let me check October, September 23. Was ist jetzt los? Time is wrong. Here, see this. I have 15 in the middle, 8 to the upside, and 7 to the downside. And the new version is here by not 10, but I will set up a new trade. That's pretty simple. Let's do it. Start a new trade, 23rd of September. This is how I set up a trade. The price is at nearly 3,000. So here's 3,000, 88 days. Then I take 15 points wide. So I have to check, do I take 3,005 or 2019? 3,005 is nearer to the actual price. So here I sell, I buy 15. I sell 8 at the upside and 7 to the downside. Oh, sorry, minus, of course. Minus 8 and minus 7. Here I have the sold butterflies, and then at about 2050, which is 5% lower about, I buy 3, then 25 points lower, I sell 6, and again 25 points lower, I buy 3. Oh, minus 6, sorry, minus 6. So this is the trade. 15 points to the upside, 15 points to the downside. This are 8, this are 7, this are 3, and this are 3. And I can't make more than 3 adjustments. In my back tests, it's not possible, it's not useful to have 8 puts and 10 puts and only use 3 of them. So I reduce them because I have to pay for these puts and I only buy 3 of them. And the less I buy, the higher the expiration line here, the profit line here at the right side will be to the upside. And this is how I trade. I set up a trade.
That's very good. Now you enter them both at the same time at entry. Dorian had a couple of questions I saw flash by. One of them was, how much of this is done in, how many orders would be involved in setting this up? In other words, would you be able to put all of this on one ticket? I doubt it. Or how many total tickets would you have?
This is one trade, and this is the other trade. I put on two orders. This is one order, and this is the other order. Not more.
Okay. The other thank you. The other question was, oh yeah, can it be done in SPX?
Sure. No problem.
Is the margin going to be a lot higher?
Don't know. I don't trade SPX. I can't tell you. But I think it's pretty the same. The thing is, you don't have to pay that much commissions as in E-mini because you have the double size.
Perfect.
But you need portfolio margin.
Oh, you do need portfolio margin.
Yeah, here you are at 5. With SPX, you are at 10. So I think you need portfolio margin, but I can't answer that question. My account is not big enough. Sorry for that.
Iggy, I was just trying to, we just talked about this, but on your your first butterfly, we've got a 15-point spread from the center to each wing. And on the lower butterfly, it appears to be wider. I can't quite see the
Yes,
numbers.
it's 25 points.
25. Okay.
Here it's 25 and here it's 15.
Great. So are you looking for any kind of volatility setup when you put these on, or you're just waiting for the signal? And
the only reason when I put up the trade is the Monday after the third Friday in March, in June, in September, and in December. I don't make any volatility adjustments because here you see I put up the volatility. What happens? Not much. It's very volatility is no case for me because of course when the volatility is very low you may get better prices, but I take the Monday and at the end of the trading session and finish. There is no any additional adjustment because of the volatility at that moment, because from the backtest I made, I made here, see you the volatility, which is sometimes up, which is sometimes down, so it's pretty mixed up all the time from 2015 here. Sorry, wrong one. Here the trade started. So the trade opened in high volatility or in low volatility. Here the trade started in low volatility. Here the trade started also in low volatility. Here the trade started in very high volatility. So, but all scenarios are in the backtests, with the breaks, without the breaks, there might be a 5% break, but there was no break. Here was a break. Here was also there might be a break, but there was no break. And this was in high volatility, for example, this trade here, this was in very high volatility when it was opened. So in high or in low volatility, I open the trade no matter what the volatility is doing, and it works.
Great, very interesting.
Does your performance table include contract commissions? Yes. This here, these trades here all include commissions like it is in OptionNet Explorer. I think it's 0.85 per option. So you see here
Interactive brokers.
Interactive brokers, yes. Here you see the commissions are included. But I don't have to pay 71.40 commissions at interactive brokers when the trade expires, because I only have to pay $37. But I may have slippage and so on, so let it run. What market condition is a Schwalbe? Market condition is when there is a sharp break to the downside. But the sharp break to the downside may stop before the 5% or will run through the 5%. Here, for example, you see very good examples. Here there was a Schwalbe with a move like that. At the next day, it will be below zero, but there was not below zero. Here again, if there is a move like this the next day, then I will be below the 5%, but I was not below the 5%. Here was a big move to the downside, and I was below the 5%, and here I cut the trade. Commissions at IB aren't 0.85 though. I really like your meta button. I'm not confident actual results are commissions and slippage will be as good as it appears. Sure, slippage maybe, maybe not. And I also, for a realistic result, I will for me, I reduce by 10% performance, for example, for a realistic result. But with my live trade, I am at the moment at what is it? Sorry, 5%. I have to do that way. At the moment, I'm at 1,200, but my realistic profit target is at about 500. And when I'm above 500, and everything is fine, but I may have to adjust in the future this value. So it's still a pretty relationship between risk and reward here. I pay a flat tool at TOS for ES. Why wouldn't anyone do this in ES instead of SPX? I can't say anything about TOS, sorry. That's from IB website. From my statement, it is 2.30. No, I don't pay that much options. There's a possibility of max rebate. Do you know that at IB? But it is very specific. We can discuss that in a separate meeting.
Hi, Iggy, I have a question.
Yeah.
So you've very nicely showed risk reduction when you're sort of selling a put credit spread. And my question is, do you think that some of the edge of the trade here is the ability to sort of play the oscillation a little bit in the market? and is that how you're getting kind of a little bit of an edge?
First of all, I don't want to make any adjustments if possible. That's the first thing, and sometimes it works because here I have a. One moment, I have an. Zusammenfassung. Here you see, this is the easygoing version without looking at Schwalbe and 3 weeks break. And here you see some of the trades. There is no adjustments in 3 months. And here and here. Sometimes the trade starts and it's going to the upside and I don't have to make any adjustment. This doesn't happen often, but here in this version, in 3 months, I do 2 adjustments. 3 adjustments, 0 adjustment, 1 adjustment, 0 adjustment. And only when a Schwalbe occurs, there have to be made some adjustments. And when the price is going to the upside, to collect some money for possible adjustments. So that's the only thing, and I don't want to do any adjustments if not possible, if it's not necessary. So is your question answered by that?
I think Dave is asking, curious also, what is the role of discretion? How much is your discretion a factor in the results?
Minimal. The first fixed adjustment is here, 1% below. I buy a put credit spread. 2% below, I buy another put credit spread. When it's going towards, when there's now here is a Schwalbe, when here is a Schwalbe, I will do adjustments by selling here this vertical. So this is going to the upside, and here it's going to this downside, as I showed it here, for example. There are different adjustments. Then I can buy back, for example, the put credit spreads I sold, because I want, when a Schwalbe occurs, I want this line to be as flat as possible to reduce the maximum risk here, which may be here or here or here or here. And then it depends on how old is the trade. Did I made some adjustments before? Was there a 3-week break or not? And then there are different possibilities, but it depends on time, how old is the trade, and how many adjustments had been made before. But the reason is still the discretionary elements are really very very limited and very few, because I only can sell three put credit spreads, not more, in the new version. So my maximum losses here are at about 3.5K. That's my maximum possible loss. But as soon as I get less than 50%, when I can buy it back, I buy back my put credit spreads here to reduce the risk. And that's why I don't, for example, I don't buy any puts anymore. I buy back my put credit spreads, which is much more, which is much better, because I don't lose power by the time, because this fat tail risk here is going to the upside. And when I buy a put credit, when I buy a put, then the line here is going down and down and down by the time. And the discretionary elements are really very low. The point is, when there's a Schwalbe, get this line here as flat as possible. by buying back put credit spreads maybe for a higher price, or here reducing here this 8 to 7 to get here this like this to get that flat. So this is much important, the 3 plus 0. And when the volatility is going to the upside, I don't care, because here volatility, let's do 20 points more. How much does this line move? Not really much. And look what happens when you have a broken wing butterfly. You have fun. And that's all about risk. And I want to exclude as much risk as possible. And I think with this trade, I have a good solution for that.
I guess that's very good. That's extremely impressive. I guess I have a question, and that's where this with the, say, the efficient market high, something like that.
There are drops.
Words,
I don't hear any every word of you. There are always drops in the when you speak. Can you please repeat it?
Is this any better? Is this any better now?
Hello?
Okay, let me, is this better?
Yes, talk.
We have a whole bunch of mics here.
Oh, yeah.
Can you hear me okay now?
Yeah.
Okay, gee, I forget what I was going to say, but let me ask you another question. How evenly does the, maybe I'm wandering around too much. How evenly does the profit accrue during the life of a trade? In other words, do you make most of your money at any particular point in the life of a trade, or is it all pretty even or unpredictable, or?
It's all pretty even, and I wait for the. I don't want to touch the trade as I wait for the expiration of the trade, and I will only do some adjustments when it's necessary, or when I can get a good price for it. And this is only when the price is going to the upside, to the downside. When the price is going to the upside, I do nothing. And the expectation of the expectation of the trade is mostly going to the upside. So I reduce here the risk from the beginning from 25 points to 15 points. So the risk is much lower. And another aspect is the T plus 0 here. Here you have about 60 points, and the T plus 0 here is moving to the downside sooner. And when it's only 15 points, even 14 days before expiration, this line is not really in the valley. It's still at the top of the valley. So the trade has much time to move to the downside or to the upside. And when it's moving to the upside, I do nothing. When it's going to the downside, it's okay, because I can here get some money for the put credit spread, buy them back when I get less than 50% when I buy that back. And that's it. And with that money, which I get here from the put credit spread, I may reduce the risk here, or lift up all the middle and the other expiration line.
Exactly. So is most of the risk in the last 14 days then?
It depends on the price. If it's here, yes.
What do you do if you are in there?
The most ugly situation is the price is going to the upside, everything is fine, then it comes back the last 14 days here, and as you see, when the price is here in the center, and I see the last 14 days, I don't get any money. I don't got any money for this put credit spreads. Yeah. And I'm 14 days before expiration. I close the trade with a small loss.
Sure. Sure.
That's the ultimate ratio, because there's nothing more. There are no more possibilities, because you don't get any money for the put credit spreads here when in the last 4 weeks. That's maybe you get $1 or $1.50, not really a good money for adjusting, because here when you buy here this butterfly, they get more expensive the longer you wait. And
Sure.
14 days before expiration, zack, weg. Bye
But
bye.
that's great the way the T+0 line stays, does not move
Yes,
to
because
maximum.
here, one moment. This is the most important thing why I reduced the C of death by 15 points. Here, see, this is 15. This is a 15 wide valley C of death, and this line here is 70 days, 72 days. So there are 16 days left until expiration, about 2 weeks, and
Yeah.
it's still here at the top of the valley.
Amazing. That's great.
And when the wider the valley is, the more you are here in this area, and then it's really getting ugly, really ugly.
Yeah.
And the last 14 days here, and when the price went to the upside and came back and it remains here, I will cut the trade. I don't like that risk to drop here to the downside. That's not
Okay,
funny.
let me ask if there are any more questions. Will has a question. Let me get over to him.
Okay, so why does the T+0 line stay so high for so long over that valley of death?
Why does it stay
Up until the
because
14 days before, yeah.
yeah, because the summary of all the trades, let me open it here, or this one. Here you have here are the trades, the size multiplied by 5. So I don't have 3 trades, but 15. And the options influence all the time by are always influenced by the trade in the direct neighborhood. And the closer the trades are, the less the difference between the trades are, because the intrinsic and the extrinsic value makes the difference why the trade still will be in a very narrow range here between the different T+0 lines. And that's the reason, because here they are, this one influences this one and this one influences this one. For example, the line for this one is going like this, and this is also the going like this, and then you have to make the summary of the two lines, and that's why you have a pretty crossing point here, which is much higher than deep in the valley. Because when there are only 2 days, when there are only 2 or 3 days left, the less days, the curve will be much closer to the point here, and that's why here the T+0 after 72 days is still very high. But of course, it depends on the volatility. When the volatility is very high, this line will be even higher, and when the volatility is very low, this line will be lower.
Okay, thank you.
Okay, any more questions? If anyone has any questions who's on the internet, you can type them in too. If we missed any, please type them in again, and we'll watch for a second. Other than that, I think we better let Iggy go because it's already, I think it's 2 a.m. or so. Now, yeah, getting toward that anyway, in Germany where he is. And I don't see any more questions. Any more questions here in the room? If not, thank you, Lee. Yeah, Lee says great presentation. Did you have any other points you wanted to make, Iggy, before we close?
No, I think I told everything about the trade, which is very important. We can do a separate meeting when you are interested in the signal service, when I will show you different trades which I made in the backtest and why I made which adjustments when there was, for example, a Schwalbe or something like that. But normally there are not really very many adjustments. There are trades which are running 3 months. Every trade is running 3 months when there is no 5% break until expiration. Every trade is running until expiration. And some trades don't need any adjustments at all.
Oh, I guess Michael had a question.
So there are 4 trade dates a year. Is that correct?
Yeah.
Okay, we straightened out a lot of points here, and thank you very much. Let's have a very nice hand for Iggy.
Thank you.
Let's close the recording.